So, hi, Paul Krugman again. I'm doing a second session with Nathan Tankus, who is everywhere these days. He's really in the middle of it. And last time it was really about Doge and what it was doing, and which has by no means gone away as an issue. But we're also having crazy action in the financial markets, which is in some ways where, as I understand, where Nathan, where you came in, and this whole discussion. And I think that we can now, I want to try and actually figure it out myself, but also walk listeners through what's going on.
Yeah.
So welcome on, I guess this is my show these days. So you were actually warning about potential financial crisis sort of before the whole post-Rose Garden stuff. You want to tell us about what you were thinking, and we can go from there?
Yeah. So I think, I've been calling this series since I've started since January 31st, the Trump-Musk payments crisis. And so this is a lot of what we talked about last time, was all of the different ways that this system could blow up. And, we talked about it some last time, but, we really emphasized that they are messing with, what the Doge people are messing at the Bureau of the Fiscal Service. What they're messing with is literally the ability to make Treasury payments. And in fact, what they're doing is so catastrophic that making Treasury payments are kind of the least of the concerns. Right. That'll be the most immediate thing, but not getting the money to hospitals, not being able to collect taxes, not being able to, the whole, it's hard to wrap your mind around because it's so big, but they literally are messing with the ability of just kind of beyond a fiscal heart attack, just making the fiscal machinery of government completely break down. And they, clearly have not really understood that they've been messing with that. And then an added layer, which I started covering around mid-March, and have been investigating for a few weeks, is, they took $80 million from New York City, or they debited New York City's account for $80 million. Just, that kind of might sound complicated, but it's just like any time that you make a credit card payment, you're authorizing your credit card company to debit your account to, so you make the payment. All sorts of other debits or credits are authorized by all sorts of actors, but sometimes these debits aren't authorized. Sometimes they're just done without warning. And normally what happens is if you do that kind of thing, it's considered fraud and you get frozen out of the payment system if you do it too much. But in this case, because it's the federal government, there's a real question. There's no actor to freeze the federal government out of the payment system. And once, there's a question, in some fundamental sense, money, the whole concept of money is making a payment, and then that payment is done. That debt is canceled. Right. You've figured it out. Maybe there's some legal dispute that comes up and they decide to sue you after, but that's a whole new legal environment. There's no I can just take it back without going through any legal process, unless you're the federal government. And so what they're shaking with the possibility that, and from all the experts I've talked to and, some anonymous sources, it seems like they really are, they really just have, there's no guardrail on their ability to just take money out of anyone's account. That's messing fundamentally with the concept of money. We kind of, when money is physical cash and I can hand you some dollar bills and then you can walk away, the idea that their payment is final is kind of easier. I have to go track you down, chase you down, have a court case to find you, and send some people out there. But with accounts, there's always that awkward question of, well, can I just take the money back at your account? And we have all sorts of legal and operational niceties that makes that concept go further and further from your mind. Obviously, there are people who experience these kind of things already, immigrants before the recent crisis, sex workers, there are all sorts of people at the margins of the financial system who know about how kind of shaky payment finality can be, but it's not a generalized thing in the whole society. It's not, for example, taking money out of New York City's bank account. And so all of these things together, where they're connecting it back to the financial crisis is if you start recognizing that the United States government is undermining the concept that a payment is a payment is a payment, and that there's payment finality, and that you have the idea that at any moment your bank account could be frozen, debited, anything else, and that you can't really trust having even just money in the bank, even if it's deposit insured or whatever, because the Trump administration is taking the prerogative that they can just take anything from you. It's there is already sort of, if financial markets took this seriously, this would already be a burgeoning financial crisis.
Okay, so that was and in some ways I feel like we should be spending all of our time on that, but on top of that we have this huge market dislocation, or what looks, a pretty big market dislocation, I should say,
Yeah.
And never mind the stock market. Neither you nor I think that that's the right barometer, but we're looking at bond markets, currency markets, and wild stuff has been happening, and I thought I was ready after 2008 for weird stuff to happen in markets, but now we're getting a whole new level of weird, and I've been reading you to try and understand. And so maybe, first, maybe just your initial take on what's been happening since Trump held up his piece of cardboard in the Rose Garden.
So we could talk all sorts of complicated details, and of course,
Right.
I've written literally 16,000 words on all the complicated details last week.
Right.
But the big picture, to kind of put the details are just to solidify the basic above the fold take, which is this is an extraordinary financial crisis because it is a financial crisis, more than any other financial crisis ever, is directly connected to the erratic and bizarre and dangerous behavior of one person.
Right.
And it's not simply the things that he's doing, but the sort of erratic moment-to-moment decision-making. In certain ways, if Trump just committed to causing a depression, if he just committed, we're going to do these tariffs, and he could credibly commit to, we're going to cause a depression, it would, of course, have all sorts of knock-on effects, but we wouldn't have had the financial crisis that we had, that I think, despite a lull, I think we're still in the middle of,
Right.
because the financial crisis was specifically about the erraticness of his decisions. For younger people on the internet, there's kind of a joke of it's so over, we're so back. It's so over, we're so back, which is just the idea of something bad happens and then you're oh, everything's done. And then something good happens, you're we're so back, everything's great, we're on top of the world. And essentially the stock market has been behaving on it's so over, we're so back mindset of just oh, Trump is going to crash everything. Oh, the business people are in charge and actually things are going to be okay. And they have been trading on that news in this frantic way, moment to moment, where even a fake headline about Trump backing off on tariffs can within 15 minutes create and then take back $2.5 trillion of value on the stock market. And so that's the top line thing, is this is a crisis of just Trump's erraticness, and Wall Street perceives Trump as somewhat less erratic this week, so the volatility has gone down, and so it's not such a crisis. So if you can believe that Trump will not be so erratic in the future, then you might be able to believe that this financial crisis is over.
Okay, now so much. I certainly, and that's, by the way, not just financial; it's real. Real investments, plant and equipment, and so on. Who can make those investments when they have no idea what policy will be a week from now? So,
Exactly.
The mechanics. I look and just see that we saw. Normally, you would expect tariffs to strengthen the dollar. Instead, it's weakened. Normally, we see interest rates go up, but it's been really weird. The spike in interest rates. It's not. And normally, again, interest rates should strengthen the dollar, but it's weakened. And then there are lots of individual markets that where spreads have widened a lot. And what I learned from you is that the picture we all kind of have of this kind of smoothly functioning financial system is really wrong, that there's a lot more, and maybe you wrote about it, and maybe I should let you talk and try to explain, and then I'll see if I can add or just reveal my confusion about all of that.
Yeah. So the way I would put it is Trump's erraticness and bizarre behavior has kind of intersected with a set of long-standing financial, regulatory, and like macro financial issues that a lot of experts have been talking about, at least aspects of, for the last decade. Kind of conversation that was burgeoning in the circles that I run in around 2017 was really just how much the new, so to back up, we had a great financial crisis. Right. It had, largely, associated with just the banks failed, they didn't have enough capital, and then also there were these set of liquidity issues. And so there's a committee called the Basel Committee on Banking Supervision, which is an informal committee, right, but has developed a lot of informal power, which is basically a meeting of a bunch of financial regulators, the United right. States, Japan, Europe, and coming together to come up with like ways to reorganize the financial system. And they've done this a few different times. There was a time in the 80s called Basel I. There was a time in kind of like the late 90s, early 2000s called Basel II. And then post-financial crisis, we got Basel III.
Right.
And Basel II, the big thing about Basel II that kind of like that a lot of people hammered on was Basel II tried to focus things on risk-weighted capital requirements. Right. So like that's a way of talking about like, okay, certain assets are a lot less risky than others, so maybe that you shouldn't like have to kind of have as much capital really, have as much net worth devoted to protecting yourself from losses for like safer assets.
For listeners, a bank mostly a traditional bank takes deposits, lends out the money, but we want a bank to have some of its own money at stake. We want some there partly as a cushion, so that if it takes losses on its lending, that it doesn't. It can come out of the bank's capital, partly so that the bank has some skin in the game, so that it doesn't take undue risks. And Basel II tried to say, well, the amount of capital should depend on how risky the things the assets you're buying, and came up with a scheme. So that's really what you're describing.
Yeah. So I mean, to kind of roll that out a little bit is, a bank, if a bank just got a bank license and they just rubber stamped it, hey, you want a bank license? Let's get you a bank license. And you suddenly had the ability to create money. You can, access the Fed. You make a bunch of loans, and then you have assets and you have deposits. And the issue is, if you take any loss whatsoever, you lose $1, then your net worth, your equity, basically just assets minus liabilities is negative. And for various reasons, this kind of just sort of like, hey, you can get a bank license and then your net worth can go negative is not something that for centuries, if not longer, financial regulators have wanted to incentivize. So what they do is they say to someone who's proposing a business plan for a bank is, hey, you need to have some starting out net worth that you can start out, that we know that as you're getting going and you're making mistakes and you take some losses, that your net worth is not going to just be negative, and that you're essentially just getting to like piggyback on the public dime, and just ability to just like change the world, make loans without anything on your end. So what you do is you find quote unquote investors, you sell them stock and then they get this stock. Oh, this is a nice stock, and then they pay you money, and that money becomes money in your account at the Federal Reserve. And then on an accounting basis, you're starting out, your assets are worth a lot more than your liabilities. And that's great. And so as you start making loans and so on, then you have that cushion of net worth to take losses. And for kind of obvious reasons, and essentially if you want to kind of make sure that people don't make so many loans and so many risky loans that they collapse, but they're still able to like make a certain amount of loans, a lot of people showed up and said, well, it should depend on the riskiness. For example, owning a Treasury bill, at least traditionally, forgetting everything that's happened in the last year, or the last 4 months, is a lot safer than making a loan to a local real estate developer. Yeah. And so why should you have to kind of have the protection of a bunch of net worth against the Treasury security the same way as you would for the loan? And so that makes sense a little bit, but the problem is in the details. The problem is, okay, what is actually risk? How do you measure risk? How do you come up with that? And it's a lot harder and it's a lot easier to game than it seems on the surface. Right. And in particular, what Basel II said was, we're going to trust the bank's internal models of risk. And, as long as their internal models of risk say it's okay, then it's okay. And I don't think it takes very much intellectual effort to think all the ways that could blow up. Yeah. And there was all sorts of details of how that was messed with and how that was manipulated to have the banks take on extraordinary amounts of risks without seeming like those risks were there. That's a whole thing on the 2007-2008 financial crisis. Whole books have been written about that topic. But for purposes today, what's important is Basel III showed up. Okay, we went a little too crazy with the risk weighting. We need to just have a sort of backstop. We need to have requirements that we need to have especially for the largest banks, a supplementary leverage requirement. So we'll have risk weighted, but we'll make sure we'll sanity check by there's this size of your balance sheet relative to your net worth that you can't go beyond. Right. And that is, and then at the same time, which we can get into a little bit more, there was all sorts of things that they did on the liquidity side. But that's the kind of big picture of, and we can talk a little bit more about how this has led into the current crisis.
Yeah, so Basel III set up a kind of a floor on capital, right? That was, and okay, so that's where we got into, and then we've been operating under that regime, and what did that do?
So what that did is it created this and it's important that it didn't just do it for these largest banks at a technical level, at a corporate level, they're called bank holding companies. Right. And what that means is they're not just the nice little chartered bank that has an account at the Federal Reserve. They have all these other subsidiaries that, engage in all sorts of different activities. These are really kind of colossal institutions. And traditionally, going way back, 50s, 60s and such, there was a technical part of the Federal Reserve Act which kind of reached into these companies and limited how much that the bank part could support the non-bank parts. Right. And a sort of really undercovered part of the 2007-2008 financial crisis, Saleh Omarova, who was Biden's Office of the Comptroller of the Currency nominee, was a Cornell law professor, now I believe at University of Pennsylvania, has a really great paper from 2010 that's all about this issue. And one of the kind of undercovered parts about the financial crisis is, as the banking system was starting to experience issues essentially about making payments, about being able to finance itself, and we'll get into that more, especially on the putatively non-bank part of these bank holding companies. And we can get more into liquidity, where there's a whole thing on liquidity. What they started to do was give waivers to these protections to let the bank part finance everything else, to essentially let finance leak out of the bank part to the non-bank parts. And that was their way of trying to keep things on an even keel. Of course, at a certain point, it got too big for this kind of maneuver. But what that meant was that post-financial crisis, it was like, okay, when things are hard and you have these largest banks, they're always just going to let liquidity go wherever in these big banks. They're not going to keep to the original mechanism of trying to keep these things separate. So we need to, if we're going to deal with this, then we need to kind of assume that liquidity can go anywhere, that funds can go anywhere within a bank holding company. And so we need regulations on the whole bank holding company. And so these leverage requirements are on the whole bank holding company.
Okay.
And their liquidity requirements, these requirements of like how many essentially quote unquote high quality liquid financial assets, and we can talk about whether they're actually high quality liquid financial assets, but regardless, that they have to hold in case they need to make payments. And so what this did, and there's all sorts of details about it, but basically what this did was it made these balance sheets quite rigid. You on one hand, you have banks that have what are supposed to be liquid assets, but they're unwilling to use most of the time, even during stress times, because the regulations tell them they got to hold on to these liquid assets, supposedly liquid assets. And at the same time, their balance sheets are kind of rigid now. They can't move up and down the way that they could before, especially for things that were supposed to be low risk. And so this brings us to the Treasury market. I don't know if you want to come.
Okay. So, all right. So, yeah, so what happened was that, so I think where we're going is that regulations, that in some sense, is the fighting the last war issue, that the regulations that were designed to limit the risk of a 2008 style crisis. And as I understand, basically the restrictions on bank holding companies forced or led other institutions to step into the breach. Is that what really is happening?
Exactly. So, I mean, this kind of gets to this like fundamental concept of liquidity. Liquidity is the idea that I've got an asset and I can sell it or make a payment at a certain accounted for value. The obvious one, which I bring up in my piece, is a dollar bill. A dollar bill is $1, and I can make a payment with the dollar. I can go to my bank and deposit $1 in my account. That's in not perfect liquidity, but pretty darn good. And same thing with just sort of money in my checking account from the perspective of me as an individual. But there are all sorts of assets out there. There are, stocks, bonds, currencies. There are all sorts of assets and trillions of dollars of assets. And, by virtue of, being assets, of being out there, someone has to own them. And if you own them, you have to hold them. And one of the kind of undercommented strengths of the previous system was that balance sheets could expand and contract a lot as you needed, and specifically around treasuries. So, okay, there's however many billions of treasuries that are being auctioned, or there's people who want to sell more treasuries. Well, there's there's a dealer, there's a government bond dealer that is that is in a bank holding company that, hey, we'll make money if we, expand our balance sheet and buy up some treasuries. So we'll do that. And hey, there's a lot of demand for treasuries right now. Our balance sheet can shrink as we sell off these treasuries and we pay back our liabilities. And so what this created was this kind of flexibility, this ebb and flow, where treasuries were liquid because there was a balance sheet that could always absorb them when they needed to be absorbed. Someone's balance sheet could expand and take them on. And it didn't require a whole bunch of action from the Federal Reserve, because the Federal Reserve could sort of just cultivate this larger conditions. And we didn't really notice that it was really the public backstopping all these things through all these powers that we've delegated. And the Treasury market, it being the quote unquote most liquid market in the world and
Right.
being stable in that way was related to these bank holding company dealers whose balance sheet could expand and contract.
So I'm just
once you
going to have
have
a clarifying question. The Treasury is U.S. federal government debt, but are you using it to mean only the short-term Treasury bills, or are you including the longer maturities?
I'm including all of it. I'm including all of it.
But federal government debt, you're saying basically anybody could wanted to sell federal government debt could easily do that, which we took for granted, but was actually because there were these dealers who were basically in the bank holding companies who were the residual buyers who would always step in, and so, but that was then.
Yeah, exactly. They were the residual buyers, and so inadvertently, when these okay, we got to deal with this risk problem, we're gonna have an absolute constraint on the whole balance sheet. What the question became, who's gonna be the new buyer? And we should say big banks have kind of talked about this. There are all sorts of let's exempt treasuries from leverage requirements, and there's a whole complicated set of debates for why regulators, why good governance types have not wanted to do that. And there's questions about whether it would really kind of fully deal with the issue, and there's stuff with liquidity requirements. But putting all that aside, fundamentally, whether or not there was an easy kind of fix on the regulation side, you still needed to have a residual buyer. And what has stepped in as the residual buyer has been hedge funds, have been sort of these investors that they find high net worth or institutions like pension funds, like universities, and they sell them what are called limited partner shares, and basically they're able to go to town and make investments, and hey, we'll get you a good return. And what these entities have been doing in terms of kind of picking pennies off of the ground has been doing that role of expanding their balance sheet, buying treasuries, and they have been hedging themselves essentially.
Right.
There's their kind of product that they can buy that can make it or supposed to make it so that this is safer, especially for those long end treasuries, for the 30-year, for the 10-year, and they have become the residual buyer and become kind of what I've been kind of putting is they have stepped into the void of a lack of monetary design from the federal government, a lack of kind of designing the system to work in this fully ways, and something sort of grew up to kind of take on this role.
Okay, and so now if until a few months ago, if you were trying to sell U.S. government debt, it would be very easy to do. You wouldn't be disturbing the price peak. But what I didn't realize was that actually, in the first instance, basically was going to be a hedge fund that would step in, and they would expect to be able to unload it. But in any case, what made this stuff easier to sell was the role of hedge funds, which, if I had known that, I didn't. Is a little alarming because basically since I was conscious, people have worried about hedge funds and are they a systemic risk? And for most of my professional life, the answer was, well, no, not really. But now you're saying that they're in the middle of the system.
Yeah, absolutely. And so this is sort of, people started really getting to consciousness of this around September 2019. There was a little hiccup, which we don't have to get into, called repo madness, but really in March 2020. So March 2020, the Treasury market started to dysfunction. And it was that moment where people started recognizing this. The Federal Reserve, of course, stepped in and bought trillions of dollars of treasuries. Kind of where my angle of my work, especially at that time, was kind of pointing to was we were covertly supporting the Treasury market in these previous instances. We were covertly doing all these things. It's a lot more obscure when the Federal Reserve issues a waiver to a technical regulation from the Federal Reserve Act no one's ever heard of in 2007 than when the Federal Reserve announces in 2020 that's going to be buying treasuries. But
Okay,
fundamentally,
by the way,
both
March
of those.
2020, in case your people have short memories, that's COVID starts.
Yes,
So,
exactly. So the COVID was a period of course, intense instability, dysfunction, dysregulation, and in that moment, hedge funds started backing away. The Treasury market started to dysfunction. We can talk about why hedge funds started backing away and the kind of problems there. But what I want to emphasize here is that, like, there's a lot of, when the Federal Reserve did that, it was like, oh my God, the interventionist Federal Reserve, and they're borrowing trillions of dollars securities. But from my point of view, issuing waivers so that, hey, bank holding companies, they can just, the bank essentially can provide whatever funds that the rest of the company needs to do, was as interventionist an action from the Federal Reserve to support the Treasury market or support liquidity in these other markets, right, as the Federal Reserve buying it. It's just, one is kind of covert, it's sleepy, it's obscure, it's very difficult to understand, and one's kind of direct. It's, hey, the Federal Reserve bought Treasury securities, so they're more liquid because they bought them. Like, it's, right, it's a thing that people can kind of grasp from, a macroeconomics 101 class, whereas the kind of sleepy regulation thing is, as I said, like, I read a whole law review article about it from, right, Biden's OCC nominee, and that's how I know about it.
All right. So what's happened now is what happened in March 2020. History all collapses in my mind. Yeah. But March 2020 was that there was a freeze up in the market for treasuries, and because the world had become wildly uncertain because of COVID. The Federal Reserve stepped in and bought treasuries, but there was a period there when actually they were hard to sell, and it basically 5 years later, almost to the day, we get another seize up. This time not because of a virus, but because of Donald Trump. And what you're saying is that basically hedge funds were not able to do their normal role. I think I know how that happens, but maybe you should spell that out a bit.
Yeah. So this is kind of, in a certain way, it's kind of funny to me because, we were talking about Basel II and all that stuff about the risk-weighted capital requirements. Well, we kind of have this bifurcated system where we solve the problems for the previous iteration of financial regulations. We solved Basel II with Basel III for banks and for bank holding companies. But then, or think we've solved it. But then, it's not like this kind of risk management practices have gone away. They're not as bad as they used to be, but fundamentally, right, at the basic level, it's a lot of the same stuff. The banks in 2005, in 2006, 2007, used value at risk models, which is a type of model of trying to calculate risk from historical data, especially recent historical data, and to see how volatile things are, to judge how risky what they're doing is. And so what happens when volatility goes up a lot, the value at risk models say, oh, there's a lot more risk out there. And thus, again, to have that conversation about capital, about financial net worth, you're only supposed to be taking on a certain amount of risk for a certain amount of net worth, for a certain amount of capital. When the risk models blow out, suddenly you're taking on way too much risk for your amount of capital. And the risk models are telling you, you've got to deleverage. You've got to sell assets, pay back debts, shrink your balance sheet. But remember, the whole point, the reason that the hedge funds have become important in the first place is their balance sheets can expand when they need to expand.
Right.
And so this is now creating a situation that is, the classic procyclical. Liquidity is there when you don't really feel like you need it, and when you really feel like you need it, it's not there. And this is why, Lev Menand, a law professor at Columbia, and his colleague who used to be at the New York Federal Reserve, Josh Younger, called them shadow dealers. Shadow dealers kind of similar to shadow money in the sense that, like, they're providing this treasury dealer role essentially of, like, they're in the market to buy and sell, but only when the times are good. And they don't, normal dealers, licensed dealers that are primarily dealers licensed by the Federal Reserve, they are supposed to kind of always be there in the market. They're always supposed to be bidding on auctions, and the privileges that they get are supposed to come with certain set of responsibilities, and of course, hedge funds have none of those responsibilities.
Right.
Yeah.
Yeah. No, I'm sorry. So I didn't mean to cut you off, but so what's happened now is that you get volatility. You get nobody knows what tariffs are going to be 3 days from now, and that ends up weighing on hedge funds, which feel the need to contract. I guess I would throw in that when you said about picking up pennies, I'm old enough to remember long-term capital management, which was a gigantic hedge fund, and people always said that their business model was vacuuming up pennies from under the couch cushions on a global scale, and it was great until it wasn't, and then suddenly blew up, and markets froze in 1998 when that happened. And you're saying that actually what we're looking at is something like that now happening again, except it's now the market for U.S. Treasuries that it actually is freezing up.
Yes. And it's freezing up everywhere. I mean, we'll get to this also, but like the same sort of things are happening in all sorts of different markets that like kind of superficially you might see as like not directly related to the initial thing. But like, to take that big picture, was essentially for various sort of complicated historical reasons over the last 15 years, a system has been built up where if things get too erratic, liquidity dries up in all these different parts of the system. And there's no balance sheet that is able or willing to absorb what's going on, unless, of course, it's, the Federal Reserve or the federal government's balance sheet. But putting that aside, there's no private sector balance sheet that's willing to kind of absorb the assets that are on there. And this is kind of where it comes back to Donald Trump, is when you have a system that is designed that it works unless like volatility goes above a certain level, Donald Trump is the perfect thing to give a heart attack to a system because, he is volatility encapsulated.
Okay, so this volatility means that hedge funds, so it really is these highly leveraged actors out there who are really critical. And you're saying it's market for treasuries and presumably a lot of other stuff as well. So there are all kinds of, you're seeing spreads blow out on not just junk bonds, but sort of BAA corporate bonds, that sort of thing. The new climate of uncertainty basically forces the hedge funds or highly leveraged actors, but I guess that's basically hedge funds, to contract and sell stuff. And so you get these combination, you get spiking interest rates even on the safest heretofore the safest assets in the world. For some of us, the fall in the dollar, that's different from March 2020. At that time, the dollar actually went up because America was still the safe haven. It's just saying that it's the enlarged role, or why is the dollar falling in the middle of all of this?
Yeah, so I think there's a few different things there. One is, I would say, before we get to exactly where the dollar is or the dollar falling in this situation, what I would emphasize is that liquidity drying up everywhere phenomenon that I was talking about. When I say everywhere, I mean everywhere. And so what has also happened at the same time is liquidity in like essentially currency trading. The foreign exchange market is also kind of seized up last week.
Okay.
And, there was an article in risk.net that said, it was, liquidity in the foreign exchange spot market was worse than COVID, which, some of these same things happened in COVID, but this happened more. And, the article says that like relative to like the period coming into this, volatility within a day, which you use the phrase, financial market participants use the phrase intraday for that, went up more than 5 times. And so that volatility explosion is really the thing that's important in the foreign exchange market, where suddenly volatility is way, way up, and it's very difficult to, suddenly there aren't balance sheets, or like you need really to like have big price movements so that a balance sheet, some entity with a balance sheet decides to step in and absorb some position or another. And, this also connects up to the last 15 years. These things called foreign exchange swaps. There's the type of derivative where you swap one currency for another. You swap yen for dollars, and then it'll go back the other way. You'll swap it at a different price at some time down the line, a week, a month, 3 months, whatever. And these have become the kind of focal point of the financial system. As of June 2024, there was $113 trillion worth of foreign exchange swaps out in the world, which is a mind-numbing number. And the vast majority of that were had dollars on one part. They're 87%. I think from my articles, 87% of that were dollars, which is a truly astounding amount. Dollars are so important to this system that, generally speaking, when a Japanese bank wants euros, or a European bank or a British bank wants yen, they don't just swap. You think of the obvious thing would be to swap yen for euros. They first swap, yen for dollars, and then swap dollars for euros. So, the dollar serves even as an intermediary between Japan and Europe. It's so central in these foreign exchange markets.
We say the dollar is the vehicle currency, and it's what you take to get a ride from one currency to the other. But that role depends, which is something I had never thought of, on dealers. And the dealers need liquidity, and wow. Okay, so what you're saying is that all this stuff, foreign exchange markets, presumably corporate bond markets, treasuries, all of it depends upon liquidity supplied, and in the end, largely hedge funds.
Yes, under our current system, and also foreign hedge funds. Right. So, it's not just that domestic hedge funds have pulled back, it's also that there are foreign hedge funds. And this is where these foreign exchange swaps and the sort of big picture about derivatives. I wrote a piece called a couple of years ago about the utopia of financial derivatives. And what that piece is really, kind of getting at is that, if you're an ordinary person, you might think lending to a New York real estate developer, or lending to a regional Japanese government, or lending to a British oil and gas company, that these are all different things. But if you have a certain kind of lens, if you see the world through a certain set of rose-tinted glasses, all the financial market participants sees are different kind of risks that can be mixed and matched. Right. And I can turn any of those kind of assets into a kind of treasury bill. I just got to buy the right derivatives. So if I'm worried about them defaulting, then I can buy a credit default swap, which is just a type of essentially just insurance against default. If I'm worried about the interest rates moving in a way that's bad for me, I'll buy an interest rate swap. And so you can sort of just construct any sort of asset you want. And this works as long as there's, as long as you don't have to worry about, actually getting paid by the other person who has your derivative. And this was, of course, the big thing in the 2008 financial crisis, is there was a big insurance giant, AIG, who took one side of all of those credit default swap bets and then couldn't pay up. And then the federal government had to step in. But even putting aside the counterparty stuff, there's also just this basic question of liquidity. My model says that when this certain event happens, this value of this asset will go down, but this derivative, according to my model, says should go up just enough to offset it. And so I haven't actually taken any loss. But the problem is, you don't actually know what's going to be happening in the liquidity, whether you can actually, whether the model value will line up because of things that can be going on in the world. For example, liquidity drying up everywhere. And there's no such thing as a liquidity. There's no like private sector liquidity swap. And of course, even if there were, the obvious question would be, who guarantees liquidity for the liquidity swap? And so ultimately, like what happens is there's all these investors who make decisions based on the idea that risks are just all swappable and they can get whatever kind of portfolio that they want with these products, and then it doesn't kind of work in crisis times.
Okay, and so we get this possibility that increased volatility means that the people who supply liquidity kind of go away, which means that all of these investments that were supposed to be safe or at least limited risk because you had derivatives start to become really problematic. And so that's what you think is happening now as we to the markets.
Yeah, I think and as volatility goes down, it gets better, but volatility is still elevated. If you look at things like there's an index called the VIX, which everyone relies on, has gone down some. So things are kind of a little bit calmer right now, but they're still quite elevated to what they were before all this started. Right. And the problem with this kind of thing is for other financial crises, there's all sorts of financial indicators that you can look at to judge whether a crisis is going to get more severe. The issue is because everything's just related to volatility, and the volatility in the situation is just related to Trump, there's no real financial expertise that can tell you exactly where this is going. It's like you just need... You need a psychologist. You need someone who's somehow an expert in Trump's mind palace or the people around Trump and how they can manipulate him or not to judge whether volatility is going to explode next week or whether it'll settle down and he'll just flip channels and not get so focused on the news that week.
Yeah. So this is what's strange is that it's not even so much the level of tariffs or it's the fact that you don't know what they're going to be. And so something like, we had one radical break in the tariff regime on April 2nd, and then a completely different, zigged in a completely different direction on April 9th, and then another big change on April 12th. And that's what's really the problem.
That's what I said, that like the financial system would do a lot better if Trump just committed to creating a depression. Well, is if you just committed to make a depression, then you'd be like, okay, he's gonna raise tariffs a lot. He's gonna stick to it. It's gonna cause a global recession. But we know it's gonna cause a global recession. What a lot of the volatility now has been about. Oh, he's gonna cause a depression. Oh, the economy's gonna be okay like it was 3 months ago. Oh, he's gonna cause a depression, and that sort of just huge swings between the economy will be fine or depression is what's interacting with these extant vulnerabilities in the financial system.
Yeah, I would say that it's not clear it would be causing a depression if the policy were stable. If we just had 25% tariffs and everybody knew that, then that would be a bad thing, but business would work with it. And it's not knowing whether they're 25 or 10 or 100 that is the problem.
Exactly.
All right, 2020, the Fed just stepped in and bought lots of treasuries. Is there a simple technical fix to this one? Why doesn't Jay Powell just step in and rescue us from all of this?
Well, so there's a couple things, and it's also important that this was, as we're talking about it kind of happening everywhere. It kind of did happen everywhere in 2022, which is why there were all those other facilities around corporate debt, around municipalities, and so on. And so
2022?
I think
is that
it's 2020. Sorry,
2020. Okay, yeah. So it was not just treasuries, and so the Fed created a bunch of. I didn't even know that they did a bunch of. I'm embarrassed, but they did a bunch of facilities for other markets as well, not just buying treasuries.
Yeah, absolutely.
Okay.
Yeah.
Okay. So, sorry. Go on.
Yeah. So and so they can step in on the liquidity issues. There's a complicated sort of set of, they're still worried about inflation, and the tariffs are bringing up the question of inflation even more. So there's kind of that kind of full spectrum thing they probably wouldn't do unless things got really, really bad. But treasuries, I would expect, they will stabilize the Treasury market. And if the Treasury market had gotten too chaotic for them, I think they would have stepped in. And I think ultimately, even if it's, some awkwardness between some of the things that they had said coming into this crisis, they would do that and it would kind of basically be fine. The problem is that, in 2007, 2008, the volatility was about financial instability and recognizing the financial instability. Right. So stepping in to stabilize the financial markets could, slow down or make the volatility go away. Jerome Powell can't make the volatility of Donald Trump go away.
Right.
And so, the Fed, for various reasons, both political but also kind of practical, wouldn't want to try to do a big audacious step in to deal with all the dysfunction related to Trump being unstable. I think, if you talk to them or if you ask them at a press conference, it would be like, well, it's the president's response. The president is making a certain of economic decisions and he is pursuing a certain of economic policy, and it's not our role to countermand him. And so if he wants to create a whole bunch of instability for his own reasons, that's essentially, his business, and we'll be concerned and we'll look at all the markets, but, we hope there's a resolution to this and yada, yada, yada. So, it's both that doing a whole bunch of things probably wouldn't work that well and would also be stepping in the void or, getting in the middle of this very charged political set of issues. And also there's sort of just as long as the Treasury can still make payments, let Trump kind of, get to a certain point and see if there's kind of a resolution to this situation. The Fed wants to be not involved with this at all, or as little as it can, and let there be a political resolution. And you kind of see similar things at a much lesser scale around the debt ceiling crises, where they've tried to really, really step out of the way and see it as a political issue to be resolved, and only step in if they think something irreversibly broken or that could break that is about to happen.
Okay, so I'm not sure if this is a devil's advocate argument or not, but is there a kind of a floor on how bad things can get? Because if the Treasury, if the Fed steps in, will step in with facilities that these kind of balance sheet volatility, contagion stuff, if it's bad enough that they can always make sure that there is enough, that they are essentially the buyer of last resort for a lot of assets?
I think, let me think about that. I think that there is, to a certain extent, that's true, but it only kind of means that for short bursts, we can take more volatility than we could otherwise take, because there's just a certain level of volatility where some of these non-bank financial institutions will blow up. I really think we were close to that Wednesday. I think if he had not backed off, if he had waited another day, I think I easily could have had a firm or multiple firms blow up and go down. And that's why I brought up a Lehman Brothers moment. Was I saw it as that serious, and and frankly trying to be one of the voices to change it, to be like, hey, this is a Lehman moment, and one of the kind of implicit things there was, so back off and try not to blow up a number of firms. And I definitely think that there is a level of volatility and a duration of volatility, like a set of days that they could do, that we would see multiple firms blow up. And then there's also a question of internationally firms blowing up. And then of course that brings up larger questions about the dollar. But I think it'll be weeks, months, maybe even years before we fully understand just how close we came. And there's like a lot of people who are keeping their cards very close to the vest because you don't want to say that your firm was like 24
Right.
hours from blowing up or whatever. But I think we're going to learn more extraordinarily alarming things about last Tuesday, last Wednesday, than is currently acknowledged or in public.
So just for time reference, so April 2nd was the first big tariff announcement, and then that was Wednesday. Anyway,
2 weeks ago.
And then you're basically a week after that, we were pretty close to the edge of a post-Lehman style financial crisis, and then Trump announced a different set of tariffs, which were actually overall maybe as high, but different anyway, were perceived as a step back from the brink. And so you were saying that the financial system stepped back from the brink, but not that far.
Yeah. And
so
volatility, volatility's still elevated. And this is kind of goes back to the piece I put out the Tuesday before last, so I guess that's April 8th, which is like is talking about the stock market, and really these kind of markets is that they're conventional wisdom processors.
Right.
They're sort of, that kind of is a reference to Frederick Hayek and the idea of, markets as an information processor, kind of saying a little bit of the same thing, but something different. They're conventional wisdom processors that there's a sort of general idea among a certain amount of people, certain rarefied group of people who are the most active participants in these markets. And what is what is conventionally believed among them is really what drives things, not sort of access to information that any sort of group of people have or consensuses among a different group of people. The stock market would change very differently if suddenly, a week from now, all the major stock traders were scientists. What they would price in, especially around things like climate change, would be very, very different from the current set of participants. So it's important, there's a lot of the way people talk about markets is these sort of objective, they just take information from everywhere and process them, but really it's a specific set of people. And you had to be as I say in that piece, you had to be a specific mindset and a specific person in the world to believe that Donald Trump would be better for the stock market than Joe Biden. That not only Donald Trump would be good for the stock market, that he'd be so much better than 4 years of Kamala Harris or whatever, that you can track the odds of Trump winning with the stock market and going up when Trump's odds of winning going up. That's a particular kind of worldview. It's, people that we don't particularly like, people that we think we're kind of nuts, and not everyone on Wall Street believed that, but enough people believed it on Wall Street that it was taken as a conventional wisdom, as not something that you should sort of fight against when you're trading stocks and trading other financial markets. And that's a unique kind of dangerous situation, because that kind of person is the kind of person who's going to look for any off-ramp, any sort of little sign that things are going to be better. And so when the stock market got, went up a whole bunch after Trump's announcement and volatility pared back some, it's not so much that, as you say, these are more protectionist tariffs. Those as of last Wednesday. Of course, it's changed even more in the week from then. Yeah. It's not like they were great, but it was just a headline in the news that would say, "Oh my God, Trump is backing off." Okay, good. And what matters is not so much the reality of this, but how them, when they interact with each other and their media apparatuses talk, can kind of come with a general mood that comes from a certain perspective. And so, it's not so much that even that Trump needs to actually back off on the tariffs or needs to be doing sane tariff policy. It just needs to be perceived as not crazy by these specific kind of idiosyncratic group of people.
Okay, and so that this is, which does raise the question if he really is going to be crazy, and eventually that will filter through. So to some extent, we may be getting a reprieve because stock traders the conventional wisdom is it's really not so bad. And that's, I have to say, I'm probably derailing the train. We should wrap up soon, but it took about 2 hours for people in my circle who actually were doing the tariff numbers to say, hey, these new tariffs are basically the same overall tariff, average tariff rate as before. They're different, but they're just as bad. But the market treated it as a major step back from the cliff, and so that was all that mattered in the moment.
Yeah.
Thoughts about? I mean, I have a feeling, and I'm worried that it may be motivated reasoning because of the politics, but that there is another shoe to drop. That even now markets have not really processed just how unstable things are. Is that your? Sounds like that's your sense.
Yeah, I mean, so I think there's two levels. I think more. I really it beggars belief that like the tariff policy is not gonna pick up, in instability, and that Trump is not gonna pick some crazy fight where you get into this, back and forth between, is he going to do it? He's not going to do it. He's going to do it, thing. And I think that kind of episode is going to happen. The other thing is just the kind of main, what we started with, the main thing that I've been focusing on, what I've been calling the Trump-Musk payments crisis, where, they could really, where impoundment and, just sort of taking seizure of the federal government, people used to like to talk about political risk. And political risk being part of what they're pricing in. Well, there's an enormous amount of political risk in the United States right now. And then there's the further point of they're in the process of just sort of claiming, that they can kind of take money out of anyone's bank account or freeze anyone's bank account. I mean, the amount of story, it's actually mind-bending trying to keep up with these stories of all the different ways that they're going after bank accounts. I mean, they froze a New York State government bank account related to EPA grants that were already handed out, that were being administered by Citibank. And I want to dig into that more and write about it more. But that's just one of I would say 4 or 5 different payment stories, which are calamitous, let alone, the recent reporting of they want to move Social Security off of COBOL, which, we talked, of course, in our first talk a lot, within 2 to 3 months. And they want to use AI to do it. I mean, that is an existential threat to Social Security existing. That cockamamie plan. And I don't know what the current state of it is. I've been focusing on the financial crisis, so I need to get back into it. But it is, I don't even know how to articulate how insane disastrous is. And hey, there's a lot of financial risk if Social Security breaks and no one's getting Social Security checks. Yeah. And these kind of risks are just a dime a dozen right now all across the administrative state. And there's just all sorts of layers, forgetting even geopolitical things of are we invading Greenland, maybe? All of these things are just so enormous. And, that's why, I didn't think I would succeed, but why in that first week of the Trump-Musk payments crisis, I was pretty conscious in that Odd Lots interview in the interview on Bloomberg, to try to really hammer just how potentially calamitous this is, the financial system, and explicitly say that all these financial markets should be pricing in these kind of uncertainties and are not doing so. So that is just, to me, the question is, there's now questions that are burgeoning up on the dollar. Of course, wrote a gigantic monster of a piece about it Sunday. I'm going to be writing some more big picture things about the dollar this week. But to me, the real question is of a disaster, of a crisis, is these people who suddenly have started to lose faith in Trump, in the Trump administration's economic policy. They start looking around and looking for other eventualities, look at other things that are threats to the dollar, and kind of come across the panoply of things that I've been covering and kind of put 2 and 2 together between, if this payment system goes down, the whole fiscal machinery that makes the dollar is gonna collapse too. Where do we go from here? And then that could potentially be a second wave of the financial crisis. But I mean, in a certain sense, I don't know whether to put it as a bright side or a negative, and I think right now I'm kind of more inclined to see it as a negative. even when something is kind of slammed obvious in their face, like Trump's tariffs, they, didn't really get the message until he kind of, had to slam their faces into the pavement a few times. Something like the Trump-Musk payments crisis, it's the kind of thing, whereas like Joe Weisenthal said at the end of that interview, that kind of financial markets will only freak out when something actually breaks. But we can't wait for something to break. That is too dangerous. That's too calamitous. So it's kind of like they'll show up and say, oh man, this problem is, so bad, when the building's already burnt down and is like, right. in a cinder.
Maybe I should leave it there. It's I need a drink. So
well, let's get that
all
drink.
Right.
One last thing I wanted to mention is this is also a sign of how bad the crisis is. My lease on an office in Manhattan started yesterday, 2,000 square feet. And so for listeners who want to support that kind of effort, make sure that venture is a success and kind of expanding Notes in the Crises into a bigger deal. Please take out a subscription, send a tip. Everything helps right now as I expand out my reporting and bring on some really amazing people to kind of contribute to do some of the things that I've been doing on different topics.
Okay, we're going to need it. So good luck, and I hope that Doge doesn't freeze your payment for the office space. Okay, thanks for coming on, and I'm sure that you will have plenty of work to do, alas.
Yes, unfortunately. I have to go visit my office.
Take care.